Valens Research, Uniform Financial Analytics.
And so Lennar, for those of you who don't know, of course, Lennar is the largest home builder in America, the largest public home builder. And for Lennar, what immediately jumps out is where we start this report, right? Where we always start whenever we're looking at a company using the Valens Research app, which is we start with the Performance and Valuation Prime page, or the PVP for short. Why do we call it the Performance and Valuation Prime? Again, as I said, we are very literal people here at Valens. We call it that because we're looking at performance for companies, right? What is the company's ability to produce returns, return on assets, ROA, and also what's the company's ability to grow its business in terms of asset growth, right? Performance of the company. And then we're looking at the valuations of the company, valuations relative to assets, and valuations relative to earnings, right? It's a cleaned up price to book and a cleaned up price to earnings ratio. And then why do we call it prime? Because we're looking at the adjusted uniform accounting metrics to understand what the real performance of these companies are. And we can see that jumps out immediately first here for Lennar is if we look at these orange bars are the distorted as reported return on assets for Lennar. And what it tells us is that Lennar has basically had a flat ROA the past 7 years, and ROA is only at a measly 6.5%, right below even 7%. But what we can see using uniform accounting is when we clean up the numbers, Lennar's returns haven't been flat. They've actually been accelerating even before the at-home revolution really took over in 2020. And returns are double what as reported metrics show. They aren't at 6.5%, they're at 14.5%. This company is 2 times as profitable as reported metrics would tell you, and returns are improving. They're not stagnant and flat like as reported metrics would tell you. This changes our context for how we want to analyze Lennar and also analyze the home building industry, which we can't see using as reported metrics. But we don't just stop with return on assets. Return on assets is really the bedrock of what we do. And then after that, we look at asset growth. Why do we look at that? Because if you combine return on assets and asset growth, what you really can get is a sense of a heuristic on what is a company's ability to be profitable and compound that return, right? And really, you can think about it as a free cash flow question also, right? Where are the cash flows coming from for the business and where are the cash flows going, right? Because negative free cash flow businesses sometimes are really good businesses if we can understand why they're negative free cash flow, which a return on assets and asset growth framework shows us. And so if we're looking here, what we can see is not only has this company been a higher return than as reported metrics show, as reported metrics have been, these orange bars have been misrepresenting how much this company has been growing or not growing almost every single year for the last 10 plus years. That can help us understand how a company's done historically. Of course, you don't just buy a company based on how it's gone, how it's performed historically. You also want to look at what's the market price going to do in the future. And with that, we can look at both a price to book metric, where you can see historically price to book for this company on an as reported basis has been higher than it is right now. But on as reported, on a uniform accounting basis, we can see actually price to book is now amongst the highest it's ever been for Lennar. The market's expectations for Lennar are higher than they normally are. And then we can look at valuations relative to earnings. Now, this is interesting because on a uniform versus as reported basis for Lennar, really for the last 7 years, there's not a big difference. But historically, there were many years that there were big differences. And this is really useful for us because it can help us understand what is the multiple the market normally pays for a company like this, and where is that trading to relative to their currently. The last chart we have here on the Performance and Valuation Prime page is for TSR. For those of you who don't know, TSR stands for Total Shareholder Return, or what is the capital performance in terms of the stock performance, your gains on the stock as it performed through the year, and also any dividend income that you got from the company combined. But we don't just look at TSR, we look at TSRR. What does that second R stand for? Relative to the index, the relevant index for the company. Since this company is obviously a US company, it's relative to the S&P 500. When this line is flat, that means that the company stock for that year performed in line with the market. When it's down, that means the company stock underperformed the market. When it's up, that means the company stock outperformed the market. And what we can see, which is really powerful, is there is a much stronger relationship between uniform accounting performance for a company and its TSR relative to the market than using as reported metrics. Oftentimes, as reported metrics don't even track what the market's doing for the company, just like we saw for the QGB 50. Why? Because the fact that the market doesn't pay attention to as reported metrics, it pays attention to the real performance of a company, exactly what we're highlighting here using uniform accounting. But of course, right, this is all really incredibly powerful in terms of highlighting what a company's real performance is and how it changes your conversation about a company. But that alone doesn't tell you whether or not to buy a stock, like I said. What does is understanding what the market's pricing a company to do versus what it can do and has done. And that's when these bars that we didn't talk about yet, these light blue and white bars, come into play. These two light blue bars are what Wall Street sell-side analysts are forecasting Lennar's profitability to be for the next 2 years when we push it through the uniform accounting framework, right? Understanding that this company is going to have booming demand for home building for the next 2+ years, thanks to how tight home building markets are and how people are truly sustainably leaving cities thanks to the pandemic and the at-home revolution. Analysts are forecasting this company to have high returns for the next 2 years. These white bars are what the market is pricing Lennar to do at a $100 stock price and a $30 billion market cap for Lennar. So with the market, right, what investors are expecting Lennar to do is for returns over the next 5 years to fall back to 7% levels, basically around where they were from 2013 to 2017. And the market is pricing Lennar to have around 3% asset growth, right, which is at the lower end of where it has been historically. So the question then for you, and this is what's so powerful about this framework, is it distills it to a very simple question. Do you think Lennar's returns for the next 5 years are going to be above or below 7%? And do you think Lennar's asset growth is going to be above or below 3%? If you think those two things are going to be above those levels, Lennar's a buy. If you think they're going to be below those levels, Lennar's a short, right? And we can use this tool, the embedded expectation tool, to understand what that means. Let's say that, for instance, you're unsure about ROA, but you do think that Lennar, which is pretty much growing north of 10% a year for the last 10 years, other than 2020, you think that this growth rate is probably going to be closer to 7%. So you can actually understand, well, what does return on assets have to be if the growth is going to be 7%, which you might have high conviction on, for this company to be undervalued? You can see, well, ROA only needs to be 6% in that case, which is basically where it was in 2012 when it was just recovering from the Great Recession. So you can see there's no way mid-cycle returns for this company going forward are going to be 7%. I think that mid-cycle returns for this company are actually probably going to be, call it 10%, right? That's basically where it was from 2013 to 2017, which is a good market, not a great market for home builders. And now what I can do is I can say, if I think that these two things are what's going to happen, I can say, what do I think the stock is worth? Not what's priced in, but what this company could be worth. And what I can see is, if Lennar were to do that, if Lennar were to have returns plateau around 10% going forward with asset growth that's at the lower end of where it has been historically, this company is worth 70% more than the market is currently pricing it. All right, I would even be having a conversation about this company having mid-cycle returns that are trading back from current levels if I was looking at as reported metrics, because on as reported metrics, returns have basically been flat for the last 7 years. And so I would expect that any decline in returns would mean returns would fall below these levels. I also would be misunderstanding valuations and everything else about this business if I was using as reported metrics. And that's the power for Lennar, is uniform accounting metrics changes our conversation about this company's performance and also rebases our understanding of whether or not this company looks undervalued or overvalued.
Valens Research, the world's leading source for uniform financial analytics.